How's it going, everyone? It's Sam. Tom Lee just talked about the false flag that's happening in the market. He talks about small caps. He talks about more risk on assets. He talks about this higher interest rate environment, what he thinks. I actually, I don't believe in something that he's saying. I have looked into it. Obviously, I'm not as smart as Tom Lee, not successful, but the fact is I'm staying away from one of the things that he's talked about. I've actually looked at buying it. I actually did buy it, did more research, and realized I don't want to be holding this. So we'll be talking about that in this video. A little bit of a change up from the normal videos. Usually I talk about Bitcoin and crypto, but we'll change it up every once in a while. You can check out the link, though, if you do want to trade crypto, to Blofin underneath the video. So definitely check that out. Be on the lookout. We do have a new Patreon that's coming here to help newer investors navigate these waters. So be on the lookout for that.
The 10-year yield touching its highest level since April earlier today. But our next guest says the rise in yields could be a false flag. Let's bring in FundStrat Head of Research and FundStrat Capital CIO, Tom Lee. He's also a CNBC contributor. Tom, good to see you. Okay, so let's start there with the yield impact. What might people be reading wrong, you think?
Well, I wouldn't say markets are necessarily reading it wrong, but I would say as uncomfortable as we are seeing yields at near one-year highs, I don't think that this is going to be the level we see a few months from now. And I think that's more important because ultimately, if yields begin to fall because inflation pressures are easing, or if the job market is a bit softer than expected, it really puts the Fed back in focus. So I guess what I would just say is it's not comfortable to be here at where yields are. I don't think it really breaks markets, but I don't think yields are necessarily moving higher over the next few months.
Well, it's particularly uncomfortable, arguably, for small caps. Early last year, probably around this time, you made a bold call on how much small caps could rise. You've moderated from that since. But where do you see small caps going now? Why didn't the big pop that you projected for 24 pan out?
Yeah, small caps have been disappointing. I mean, unfortunately, I think there's been a rug pull on those names a few times, so I think investors are going to be very wary. But to us, I think the roadmap for 2025 is still one where the opportunity for stocks to have much better breadth widens, because not only do we have an incoming administration that is pro-business, and I think it is going to boost CEO confidence. It's pretty evident now, even seeing it in both ISM readings recently. But that's going to be a better environment for mergers. So to me, while small caps have been big laggards, actually for the last 10 years, this 10-year underperformance to the S&P is the worst in actually almost 100 years. So it's second only to 1998. And then from a valuation perspective, small caps are still much more attractively valued. The median PE is around 11 times, and that's almost 7.7 turns cheaper than the S&P. So it's been tough, John, to be overweight small caps, but I think they're going to work in 2025.
Okay. I do want to get your thoughts on some of the riskier assets or the riskier parts of the market that, or I'll use the word maybe potentially more speculative. Case in point, the quantum computing stocks, they had a huge move higher. Jensen Huang from NVIDIA comes out yesterday, makes comments saying that, some of the supercomputers are still, and the full, I guess, realization of supercomputers is still decades away, and you see all the stocks tumble. I know there's one that you like in your granny shots here. I believe it's IonQ. Just want to get your thoughts on what we've seen in some of these parts of the market and how to think about investing, if you should be investing in some of these more speculative or futuristic frontier tech-like companies.
I think investors do need to put a long-term lens on a lot of these important mega themes. I think quantum computing is in the earliest days. I don't think anyone can judge really whether it's 15 years away or 15 months. And I think people have made many mistakes over the past 20 years looking at things like social media and underestimating the adoption rates there, or internet, or even AI now. I mean, just think about 2 years ago, how many people were saying AI was going to actually take far longer than expected. That being said, I do think the environment for stocks hasn't been great for the last 3 weeks. I think it's really gotten people into a recency bias, thinking, look, we've neared a top, or that stocks are just awful now. I think we're getting close to the point where you should be betting really and leaning heavily against that. I mean, even look at AI sentiment, it's almost back to negative. But Morgan, regarding quantum specifically, it is a pretty innovative technology. I think these are going to be high volatile names. And so until we get back to risk on, they are going to be tougher names to own, but I don't think that means you have to sit them out in 2025.
Tom Lee obviously talking about yields, saying this could be a false flag and that he still likes smaller, riskier assets like, like the small caps. I actually looked at small caps a little while ago, and I was going through one of the top small cap indices or ETFs, and I'm not impressed by the companies in the small, in like the Russell 2000. The ETF I was looking at was AVUV, and I was digging through their top 10 holdings. And while they're a lot more diversified than something like the S&P 500 or the NASDAQ, QQQ, they still, the quality of company is not as high. Just going through their financials, a lot of them had, cash flow that was up one year, down the next. A lot of them did not have growing profitability. And when you compare that to something like the S&P 500, look at Microsoft, look at Apple, look at any number of companies like this, Google, Amazon, like they are up and to the right. They're very strong companies with wide moats that have very good cash positions. They're printing money. They're happy when there's a higher interest rate environment because there's more yield for their cash. They're happy in a lower interest rate environment because people are spending more. Like no matter what, these companies are going to be around. So then looking at something like the Russell 2000, like I said, much lower weightings, like in the S&P 500 and NASDAQ, you can get a 6% weighting towards a company, and this is 0.5%. But let's just look through the top 5 holdings. FTAI does have growing revenue, growing EBITDA, but negative free cash flow pretty consistently. This one's a little bit harder to read, and obviously I haven't looked at what they actually do. But SFM seems to be, each year growing a little bit. EBITDA is growing a little bit. Cash flow has been going down over the last 4 or 5 years. Net income has been going up. Obviously, I'm not looking deeply into this, but look at the next one. INSM, negative EBITDA, negative free cash flow, growing revenue. Like what's going on there? The next one down the list, PCVX, negative EBITDA, negative free cash flow, growing cash, it looks like. This next one, Credo Technology, growing revenue, EBITDA's all over the place, free cash flow's all over the place. Like it's just harder to gauge versus something like Google, where you just continue to see the same thing year after year, growing, margins growing, EBITDA growing, EPS growing, cash going down, but also buying shares. Like it's just a totally different level of company. And while it is trading at a 10 PE ratio, the fact is the quality is a lot lower. They're not growing as quickly. They're not as predictable. So I look at it and say, well, yeah, these can definitely do well, especially if we go into a lower interest rate environment. It might be like a speculative play, but these aren't companies I really want to own. I don't think that like if you buy it and all, interest rates stay at the same place, that these are going to outpace the big tech players these days. They're much cheaper for a reason. Let me know your thoughts though. Obviously these companies are a lot riskier in a higher interest rate environment. They're not in as good a financial position. Obviously we talk about crypto a lot on the channel too. I think in a higher interest rate environment, obviously like people feel a little bit more reserved about buying something like Bitcoin, but also Bitcoin went up 20%, 140% last year. And we just had a couple rate cuts. And this year, it's just kind of back and forth. It's just chopping around. But I think Bitcoin can still do well in any interest rate environment because at the end of the day, it's about adoption, right? How many people are buying, how many people are coming into the space. And right now, we do have word that one of the biggest buyers ever might be coming in the next couple of weeks with the U.S. government and Trump saying that he's going to create a strategic Bitcoin reserve. So it'll be interesting to see how this all works out. Again, if you want to trade crypto, there's a link to Blofin underneath the video. Obviously, trading is risky, but if you want to try it out, there's that link. We've been able to make good amounts of money through leverage trading. But, of course, like make sure you know what you're doing. Let me know your thoughts on all this underneath the video. Let me know what you think about what Tom Lee said. Thank you so much. I'll see you in the next one. Bye.